My name is Amber Canody, and I am a tax supervisor here at Hantzmon Wiebel. Today, I have the pleasure of discussing the guidelines for determining whether or not a business should be filing a tax return within a state for about the next half hour. I wish I had a magic wand and I could wave and make multi-state tax way less complicated, but sadly I cannot. So every state is different. There's no one clear answer I can give you, and every client is different. So state tax filing determinations should be made on a client by client basis. With that being said, let's go ahead and talk about what can trigger a state filing requirement. So Nexus is the trigger that will cause a business to have a new state filing. I'm sure many of you have heard of this term and know what it is, but for those of you who are hearing this word for the very first time or need a refresher, nexus is a situation in which a business has tax presence in a particular state. So in other words, nexus is a connection between a state taxing authority and an entity that must collect or pay the tax. So to simplify that even further, it means you have sufficient physical presence or economic activity within a state. So as we all know, states like their money, and Nexus is the way they get their fair share of the income tax pie. And before we start digging too much into the detail about different types of Nexus, it's probably a good idea to go over how the concept of Nexus has changed. So over time, the physical classification for imposing an income tax has changed as interstate commerce has become more common. Even if a taxpayer has minimal presence in a state, this can create nexus if a state has not established some type of de minimis safe harbor. A prime example of this minimal activity that would create nexus is just having one remote employee working from home in another state. So we are seeing this a lot more frequently now in this day and age with how things have progressed. So some states say that if you're receiving income in their jurisdiction, that's enough to create nexus. Other states have de minimis thresholds that are either dollar amounts or a number of transactions to give small business owners a safe harbor. And with these exceptions, eliminating tax obligations in some states, it's not true for all states. Not all states have these exceptions. So a de minimis standard you may see in some states includes a limit on the number of days people are allowed to be physically present in a state before they are subject to income taxes. Generally, if a taxpayer spends less than 10 days in a state in one calendar year, they would not need to file an income tax return in a state that has that exception. So if that state does not have that exception, that rule wouldn't apply. So these changes to nexus laws in various states has made it very, very important that businesses know where their workforce is by tracking location of each business activity and knowing where that business is receiving income. So back to Nexus as it is today, there are many ways for Nexus to be created, and each state has different rules. So some of the different types of Nexus include physical, economic, factor presence, agent, affiliate, and click-through Nexus. And for purposes of this presentation today, I really just want to focus on kind of the three big ones that we see a lot, which is physical presence, factor presence, and economic activity nexus. So first, let's go over physical presence nexus. So physical presence nexus is created when a business has a physical connection with a state or taxing jurisdiction. This would include having facilities, employees, inventory, or some other type of property permanently located within the state. It also includes employees or property temporarily located within the state. So some of these examples are solicitation, installation, other types of services, and delivery. And then last but certainly not least, Agents within a state on a permanent or temporary basis would also trigger a business to have physical presence nexus. So rules and exemptions, they vary by state, which we all know. And this would take forever to discuss due to so many different nuances between all 50 states. So I already mentioned a few exceptions earlier that you may see, but there's one important exception that I did leave out. And one of these that generally applies to most states, not all, but generally, is something called Public Law 86272. This law prohibits states from imposing a net income tax on income received from interstate commerce if the only business activity within the state is the solicitation of orders of tangible personal property. So keyword in there is tangible personal property and solicitation. So if all a business is doing is soliciting sales on tangible goods, they are able to claim 86272 protection on their tax return, but not be subject to income tax within that state. So in a nutshell, you still are filing a return in that state, but you are able to claim that 86272 protection, and you do not have to apportion any income there and pay no taxes. So some common examples of physical present nexus that we see in businesses are having a physical location. So that's your brick and mortar businesses. It also includes owning or leasing a office or warehouses in other states. Another example would be sending employees or agents to other states. And then the other example that I see a lot is temporarily doing business in a state. So what does that mean? That includes like your trade shows or your craft fairs, and that's for a very limited period of time. So the other factor that I mentioned earlier is factor presence nexus. Under this factor-based nexus, an out-of-state company has nexus if its property, payroll, or sales exceed a certain threshold during the tax period. These standards were recommended by something called the Multi-State Tax Commission, which is a governmental agency that creates standards that states can choose to adopt. So not all states choose to adopt these standards. Generally, the thresholds are around $500,000 of sales, $50,000 of payroll, $50,000 worth of property, or 25% of total property, total payroll, or total sales. So any amounts over these thresholds would trigger factor-based nexus and trigger a filing requirement. However, not all state limitations are the same, and they vary in their threshold amounts. So this is a common theme we're going to see throughout this presentation. As we know, states aren't the same. They're all going to have their different rules, and they all vary. So an example to think about using the Multi-State Tax Commission standard guidelines, let's say a taxpayer has about $650,000 worth of sales, and their threshold is $500,000. Well, since the sales exceeded that $500,000 threshold amount, the taxpayer would have a filing requirement in that state. So the key takeaway is if a taxpayer meets any of these thresholds or and above, they are deemed to have income tax nexus in that state. All right, on to the next one, and this one's a fun one. It's called economic nexus. And this is the last one I kind of want to dig a little deeper into for this session. Economic nexus is the latest hotness due to Wayfair. The Wayfair case is related to sales tax, but it can also affect income taxes as well. So for those of you who need a refresher on what the Wayfair case is, let me enlighten you. South Dakota versus Wayfair. So that's a 2018 US Supreme Court decision that gives states the right to force out-of-state sellers to collect and remit sales tax, even if they do not have physical presence within that state. So Wayfair basically established nationwide the core of South Dakota's economic nexus legislation. These laws say that sellers are liable for the collection of sales and use tax if they meet or exceed a state's economic threshold. So companies reach these thresholds if they sell a certain amount of personal or electronic property into a state in a given year, or they make a certain number of transactions per year in the state. So the Wayfair decision means that online sellers need to collect, register, remit sales tax in far more states than they used to. So we had under like the old rules, which were Quill, Wayfair basically kind of built on top of this, and they basically are saying a seller who needed physical presence in a state to be on the hook for sale tax, that no longer applies. Now through economic nexus, the door is wide open. So this new definition of economic nexus is defined as any seller who does not have physical presence in a state shall remit sales and use tax if the seller meets those two tests mentioned earlier. So that's that gross sales test and then the number of transactions test. This definition has basically changed the entire ballgame in regards to nexus, where you don't necessarily need physical presence in order to have states come knocking on your door like you used to. So most economic laws throughout the states mirror the South Dakota law. However, states like to adjust things to their own needs, and they have the one thing they've adjusted is kind of the language and then these thresholds. So some of these thresholds can have $100,000 of sales, or some of them are as high as $500,000 of sales. And then they all have a relatively like normal amount of transactions. So I think on this next slide, yep, I have a map that kind of goes through all these different nuances within the states. So as you can see, most states have jumped on this economic nexus bandwagon. There are only 4 states on this map that do not have the economic nexus. So that's Oregon, Montana, New Hampshire, and Delaware. So if we look at this map, we see all these various colors. We have our light orange, we have our medium orange, and then we have this like this dark burnt umber. And as you can see in the threshold legend, you can see that some of them are just 100,000 of gross sales, and then you see that some have that transaction test. And one thing I really do want to point out is you see the language, the or and the and that are highlighted in bold. So some of them you have to meet both tests, and some of them you just have to meet one of those tests in order to have economic nexus. So this is just a word of caution, something to be on the lookout for when you are making these nexus determinations to see if you have filing requirements. So you may be wondering, why does this even matter? This is referring to sales tax. So while the Wayfair decision did not directly impact income tax nexus, the removal of a physical presence requirement for sales tax, it may encourage more states to enact a sales factor threshold for income tax nexus. So generally, when a taxpayer starts filing sales tax returns and they're registered in these new states, they're usually going to be required to file an income tax return in there as well, even if there's no income to be apportioned there. So I know with a few of my clients, they had to register probably in about 10 new states because of sales tax. And we are filing income tax returns with zero income apportionment and tax there just because they are registered to do business there. So in Alabama, California, Colorado, Connecticut, etc., they already have these bright line tests in place, which consider a business with certain levels of property, payroll, sales to have income tax nexus. So that's referring back to factor-based, if you remember. But with Wayfair, some of these other states are starting to enact their own gross receipt taxes. Some of these states are Ohio and Washington, and they've decided to kind of throw their dart in the board, and they have come up with their own tax. So I think in the future we're going to see more and more states coming up with these type of gross receipt taxes that are going to trigger many filing requirements. So states are regularly enacting changes related to nexus and various types of taxes. as taxpayers' businesses become active in other states, it's so very important to discuss potential income tax exposure, which is a great segue to my next slide, which are nexus studies. So what even is a nexus study? That just sounds like a fancy term. So it's a deep dive into a entity's business activity in a state or multiple states that determines if that activity is creating nexus. So remember from what I said earlier, nexus means you have sufficient physical presence or economic activity within a state. So these studies have gotten way more popular ever since Wayfair, and they're just a great way to figure out what a taxpayer is doing and if that level of activity is triggering a nexus and a filing requirement. So if the taxpayer has activity in various states but has not been filing there, you would probably want to do a nexus study to see if that's a new state you should be filing in. So these studies look at what the taxpayer is doing and if that activity rises to the level of doing business. They also look at determining what filing requirements you have. And these can include sales tax, income tax, franchise tax, and so much more. And then one little caveat that I do want to mention, physical presence will usually override the economic nexus rules. So if you have physical presence nexus there, that's your filing requirement right there. You don't even have to start looking into economic nexus because you have that physical imprint there. All right, so moving on to a nexus study approach. If you ever consider doing a nexus study on your own, I would recommend starting with states with the largest amount of activity and working your way down. With 50 states, these nexus studies can get super overwhelming, and it can be cumbersome. So I would recommend start big, work your way down, or you could go with the easiest approach and you just give the study to a member of our state and local tax team, and we will work that up and give you our results. So here's an example of some of the questions that Hantzmon Wiebel has on their Nexus questionnaire. So as you can see, what we're really trying to accomplish is getting to know our client and their business. What are you doing? Where are you registered? And kind of figuring out, all right, what's your current tax exposure and what's that potential exposure in new states? So this is a great starting point for us to really get to know what our clients are doing. So you've done this Nexus study, you've got it completed, and you've kind of figured out what states you are now required to file in and identified. So you will need to calculate the risk if the taxpayer has had activity in a state in the past and you've never filed there. So you'll need to look at the taxpayer's exposure in previous periods and calculate the taxes owed plus any related penalties or interest. So now that I've kind of given you the full picture, you can kind of present your Nexus study to the client and they can decide how they want to proceed. They could choose to keep their head buried in the sand and continue to file as they are. Or if they decide to file in these new states, they must also choose if they want to start filing prospectively, which means you start to file from now on and you don't worry about the past unless you end up getting audited. Or they can choose to use a voluntary disclosure agreement if the state offers it. And really, this is the client's call to make. We're giving them the resources they need in order to make an informed decision. So if they want to take the riskier option, that's on them. If they want to go super conservative and file in all these states, again, that is on them. We are just the trusted advisors giving them all the resources they need to make that informed decision. So we just mentioned voluntary disclosures agreements, and you're probably wondering what that is. So in states, they have these programs that allow taxpayers to receive certain benefits from proactively disclosing prior period tax liabilities in accordance to a binding agreement that you make with them. So most states offer these agreements, which is very nice. and they use them to encourage companies to comply with a state's tax laws. These agreements generate revenue for the state that it may not have had before, and it also reduces the burden of them coming after you. So basically, for the state, it's a win-win. They're getting money and they're not having to use all their resources to come chase you down. So some of the positives of these voluntary disclosure agreements include limited exposure, limited tax liability, and sometimes limited penalties. They also offer anonymous negotiation, and then a clean conscience if this is something that's been keeping you awake at night. So that's a great bonus of voluntary disclosure agreements. And then some of the negatives that can come from this are let's see, if these things can be super finicky. So if you are missing any detail at all, you can become ineligible to use the program. So there are various requirements that you must meet in order to be eligible for these agreements. And you need to make sure you have everything ready and that everything is correct. And it can be a very tedious process. And then lastly, when you get into these agreements, sometimes additional tax liability could be uncovered. So my biggest recommendation when considering these VDAs is make sure you're doing your due diligence to ensure that a voluntary disclosure agreement is the right move for you, for your client, for a taxpayer. It's very important. So make sure you're here crossing all your T's and dotting your I's. So you have this Nexus study done, and you may think you're out of the woods because you've done it. You like check the box. I got my Nexus study done. I'm filing in all these states, but it's not a one and done thing. So a good practice is to have a Nexus study done every few years. These studies should not be as hard as the initial study, so that is a bonus. If you do this at least once every few years, you can see if there are new states to be filed in, since these laws are always changing, or it can help you identify a state that you might not need to file in any longer. So I don't think anybody would be disappointed about taking one state away from your tax return, because I know that can be tedious and cumbersome and expensive to have so many states on a tax return. So we're going to pivot a little bit and talk about individuals for a little while. So just like businesses, individuals can also have tax returns in multiple states. One of the most common sources of multi-state income that I see is from partnership and S corporation K1s. So sometimes the company will file a composite return on the individual's behalf if they elect into it. Other times they will withhold a non-resident tax. And then another scenario is you might see income sourced to the taxpayer that the company did not pay any type of tax on. So I'm going to go back a little bit and kind of tell you what a composite return is. So for those of you who do not know, a composite return is a return that is filed by a pass-through entity that reports the non-resident owner's share of the state income, and it also calculates the tax that is paid by the pass-through entity on behalf of this non-resident owner. So the owner does not have to file an individual return in that state. The other thing I want to circle back around on is what in the world even is this non-resident withholding tax? So these taxes are mandatory prepayments of tax for individuals and or entities that are not residents of a state. So the owner would need to file an individual income tax return in order to claim that withholding tax on their return to offset any liability generated by the income sourced to them. So some considerations to think about when determining whether or not a taxpayer should elect into a composite return. Does the individual owner qualify to participate in a composite return? That's step one right there. Do they even qualify? Step two, can the individual still file a return even if they have participated in a composite return? And then last but not least, do the owners have any other source of income from that state? These are all very, very important questions that need to be addressed when making these decisions for multiple states. All states' laws vary, again, so make sure to review each individual state's requirements very carefully in order to make sure that your taxpayer qualifies. So some of the great things about a composite returns includes that it's super convenient. When you're doing an individual's return and you have composite filings, it makes your life so much easier. You can also get state tax credits for taxes paid to other states. And then there are a few exceptions being Arizona, California, Oregon, and DC. It also eliminates the need to file those non-resident tax returns, which can be costly and also complex when you have to look at all these different state rules. So that's definitely a big plus. And then last but not least, you get to shift that burden of dealing with tax notices and audits to the entity because you're not filing in that state. The entity is on your behalf. And there are a few disadvantages, but there's not many. In some states, a taxpayer may be subject to the highest marginal tax rate for their non-resident income. And then if you choose to do composite, you're also forfeiting that state tax benefit of getting those exemptions and deductions, which can lessen the amount of tax due. But with all that being said, I would still recommend opting into composite returns for most states. So if that's an option, I would definitely do your due diligence and look into it and see if it's the right fit for your client or for yourself. So I think with that being said, that is the end of my presentation. Let me know if you have any questions. Our state and local tax team, we're always happy to help. We put in the work, we do our research, so we want to make sure we're giving you guys the best services possible. So that is it for me. You guys let me know if you guys have anything in addition. I'd be happy to talk about it.